Good day. Allow me to introduce myself. My name is Marnelli P. Perez from BM7018. And now we are going to virtually report and to present to you the financial statement analysis. Here are the presenters of the report.
I'm Mary Jane B. Mercado from 701A.
Hi, I'm Jim Toledo.
Hi, I'm Ruby Garcia, BM701A.
I'm Hannah Giselle B. Inidal from BM701A.
Under the financial statement analysis is the understanding about the financial statement analysis. The second one is the financial ratios. Different formula of ratios was there, and the third is the alternative accounting method. Financial statement analysis. As you can see at the report here are the slides. There is a situation between the people and they want to ask something. And you know, in a financial statement analysis, there will always be a problem. They will always be asking, just like the stockholders, the creditors, and the management. The stockholder will always ask, how good is our investment? If I want to invest in a business, I will expect that there will be a return of profit. That's my mindset. The creditors, will I be paid? Yung mga nagpapautang, meron bang ang kasiguraduhan na mababayaran sila? And the management, how are we performing? That's why we have this financial statement analysis. But first, we have to explain what is financial analysis. Financial analysis is the process of identifying the financial strengths and weakness of the firm by properly establishing relationships between the item of the balance sheet and the profit and loss account. Financial analysis can be undertaken by the management of firm or by outside the firm. What else could be better speak for the company's performance other than financial statements? Because just what I'm saying a while ago, there will always someone wants to ask, there will always be a doubt. Companies are still being questioned with the way they present their financial condition. Scrutiny of the public eye is an avoidable existence in the business because when you are talking about money, nobody wouldn't want to be taken advantage of. And in order to eliminate those doubts, those problems, those who are asking, those who wants to question, you have to be consistent because consistency is the key. You have to consistent being honest, being clean with what you do. Clean record, honest record will think that the organization, that the company will think that you are serious with what you are doing. And that is what important. In the business, you have to be transparent. Consistent, transparency. Consistency is the key, transparency is the
Limitation of financial statement. The financial statements presents facts about financial condition and summary of company operations, but the interpretations of figures greatly depend on its users. Next is comparative statements. Is to made to access the company's financial condition based on another data or records in similar format made in different time frame. The comparison could be done by management in three ways. Number one is within the company. Number two, with competitors. Number three, industry-wide. And the last, common size statement. Our financial document displaying all items as a percentage of a common base figure.
Under the financial statement analysis is the horizontal analysis. It is an analysis of percentage increase and decrease of related items in comparative financial statements. Horizontal analysis is also called trend analysis. And you can see the example, Montes Company is a computer provider and they started a business on 2001. After 3 years, they decided to start a franchise business, and that is 2003. This is the financial data of Mundus Company. How will we solve the changes over the year? We have the changes since based period in percentage. When we calculate horizontal analysis, it will always be a percentage every year. The formula is current year amount minus base year amount divided by base year amount. Just like an example here. The current year amount is the 2003, which is the 1,498,000, because it says here that we have to convert it in millions. After that, the current year amount is 1,498,000. We have to subtract it to the base year amount, which is the 2001, 1,115,000. And then we divide it to the base year amount. After that, we have to, in order to get the percentage of the horizontal analysis, we have to multiply it by 100 in order to get the 34.35%. And current results in relation to base period, the formula is current year amount divided by base year amount. In order to get the 2003 base period, we have the formula here. We have the current year divided by 2003 amount divided by 2000 amount. 2003 amount is 1,498,000 divided by 1,115,000, and you only have to multiply it in 100, so we will get the percentage. Also under the financial statement analysis is the vertical analysis. Vertical analysis, it is a technique for evaluating financial statement data that expenses each item in a financial statement as a percent of base amount. Total assets is the base amount in vertical analysis of a balance sheet. Net sales is the base amount in vertical analysis of an income statement. Vertical analysis formula in balance sheet. Vertical analysis formula equals balance sheet item times total assets or total liabilities times 100. Just like an example here of Mundus Company. We have the assets, liabilities, and shareholders' equity. We all know that the basic accounting method is assets equals liabilities plus owner's equity. In order to get the vertical analysis, the participants or the terms, example here, cash and marketable securities is 6,029,000. You have to divide it to its total assets and then multiply it by 100 to get the percentage. 6,029,000 divided by 39,985,000, we have the percentage of 15.1%, and so on and so forth, just like that.
Financial ratios. There are indeed a variety of financial ratios, but only the most common will be discussed. Specific intentions for more detailed information would depend on what is the purpose and who will be the evaluator of financial statements. Liquidity ratios. Liquidity means the ability to quickly convert assets into cash. The most common used ratios to measure liquidity are current, quick ratio, and net working capital ratio. Liquidity ratio is under the current ratio. Current ratio is measured the company financial strength and relative efficiency, and also it tells channel property to maximize profitability or simply the ability to have the cash readily. It tells how much assets are likely to be converted into cash with 1 year to satisfy current obligation. To simply get the current ratio, this is the formula for current ratio. Current ratio is equal to current asset over the current liabilities. That's all. The second one is quick ratio. The most stringent or rigid test of liquidity, the ideal ratio is 1:1. This indicator will be used by creditors to measure the firm's ability to pay its short-term debts when it's due. Allow quick ratio will leave the company with financing difficulty as borrowing of funds may come tight. The formula for quick ratio is quick asset over current liabilities. That's all. The third one is net working capital ratio. Net working capital ratio measures the percentage of net current asset after deducting current liabilities over the total assets of the business. Reflecting a higher ratio means the more control stockholders have over the business, thus manifesting stability. The formula for getting the net working capital is current asset minus current liabilities. But how to get net working capital ratio is net working capital over the total assets. That's all. Thank you.
Solvency ratios. Solvency is a measure of financial soundness of the business and how well the company satisfies its long-term obligations. So the formula to measure the company's solvency is varied. The measurement to be used depends on what information the users would want to know. Current liabilities to net worth ratio is equals to current liabilities over net worth, and net worth is equals to total assets subtracted by the total liabilities. So current liabilities to net worth ratio can be computed by dividing current assets by net worth. The ratio indicates the amount due to creditors within a year as a percentage of the owner or the stockholder's investment. Current liabilities to inventory ratio is equals to current liabilities over inventory. So current liabilities to inventory ratio is simply dividing current liabilities by inventory, which tries to extract an indicator on how disposal of unsold inventories could possibly finance the business current obligation in case it comes due. If combined with net sales to inventory, it tells how these unsold units were managed effectively. Total liabilities to net worth ratio is equals to total liabilities divided by net worth. Total liabilities to net worth ratio is derived from adding all liabilities, which are current, long-term, and deferred obligation of the business, and dividing its sum by net worth. The purpose of this measure is to establish the impact of long-term debt on the business. Fixed asset to net worth ratio is equals to fixed asset over net worth. Fixed asset to net worth ratio reflects the percentage of asset centered in fixed asset compared to total owner's equity. The proportion of fixed asset to net worth is preferred to be low as high ratio implicates possible over-investment. Profitability ratios offer several measures of the operating success of the firm in generating desired or more than desired income in a given period of time. Many of the financial ratios can be applicable to measure the company's income achievement. Return on assets, or ROA, is equal to net income over average total assets. Return on assets ratio measures how effectively the firm's assets are being used to generate profits. Return on equity is equal to net income divided by average stockholders' equity. So ROE, or return on equity, is known as return on net worth, measures how effectively the firm's assets are being used to generate profits. Return on common equity is equals to net income over average common stockholders' equity, wherein average common stockholders' equity is equals to beginning common stockholders' equity plus ending common stockholders' equity all over 2. Return on common equity is one widely used measure of profitability taken from the common stockholders' viewpoint. The higher the ratio, the more common stockholders would be enticed to invest in the business. Profit margin is equals to net income over sales. So profit margin ratio is also known as rate of return on sales. The profit margin ratio measures the percentage of each dollar of sales that results in net income. Earnings per share is equals to net income divided by the number of common shares outstanding. Earnings per share is a measure of the net income earned on a per share basis. This expression has more appeal to the stockholders as each is definitely concerned with the multiplier number of stocks which determines their total earnings.
GAAP, or Generally Accepted Accounting Principles, serve as the guideline for accounting or recording the activities of the firm. In other words, it is simply accounting standards, are the framework for the rules and standards that dictate how financial statements are prepared. Its purpose is to interpret accounting data used by other countries. For example, a Filipino investor is interested in a business in Japan. If the investor is unable to interpret the business financial statements, how do they know the financial health of a business and whether or not it's worth investing? Pro forma income is a data presented excluding financial statements which management find to be irrelevant or unusual to its operation. Thus, these values are assumed to be immaterial in amount and may be considered to be omitted from the documents made available to the public. However, some companies have been known to abuse this practice by repeatedly excluding items that should normally be included. Investors should therefore exercise caution when using pro forma earnings in their fundamental analysis. Unlike GAAP earnings, pro forma earnings do not comply with standardized rules of regulation. As a result, earnings that are positive in pro forma scenario can be negative once GAAP requirements are applied. Improper recognition. The most common abuse in statement of earnings is the improper recognition of revenues. For example, when a product is sold, revenue is recognized when the customer pays for the product. However, accounting for revenue can get complicated when a company takes a long time to produce a product. GAAP states that revenue must be recognized only when earned. By simply recording revenue early, a dishonest business seller trying to inflate a sale to create the illusion of a greater than actual profits.